Hi and Assalamualaikum. So today our group will present about financial ratio analysis of Pizza Hut and Domino's Pizza. I am Siti Nur Amalin will proceed with the background of the company. As for Pizza Hut, in 1958, two students studying at Wichita State College in Kansas craving for pizza, so they borrowed just $600 from their mother. That is how they embarked on a journey that will change the American pizza landscape. Their first restaurant did not just serve delicious pizza, it offered new kind of dine-in experience, a place where families and friends could come together and enjoy their meal. Affordable meal, unlike anything else on the scene at the time. But now, Pizza Hut had been acquired by Yum Brands. As for Domino's Pizza, unlike Pizza Hut, which focused on creating a dine-in experience, Domino's has a different vision. They envision a world where pizza was not just sit-down meal, but a convenient and quick solution to satisfy hunger. They optimized delivery routes and introduced the famous 30-minute or less guarantee delivery. Domino's was an early adopter of technology, investing in efficient ordering systems and later becoming the industry leader in online pizza ordering. But both of the company has a similarities with they both rely primarily on the franchise model.
I'm Sarah, and for the next one is the liquidity ratio. For the current ratio in 2021 of Pizza Hut is 1.083. Meanwhile, in 2022, the ratio fell to 0.9664, indicating potential liquidity strain, but it was reversed in 2023 because current ratio rose to 1.26. For the quick ratio in 2021 was 0.7647, but in 2022 was observed because the quick ratio was falling to 0.6096. But fortunately, by 2023, the quick ratio rebounded to the 0.9780, giving an improvement in its liquidity position. For the last one is in liquidity ratio is cash ratio. In 2021, Pizza Hut cash ratio was 0.3435. Meanwhile, in 2022, it was recorded as decreased because the ratio dropping to 0.2204. But in 2023, Pizza Hut cash ratio has risen to 0.4009. Then for the next one is the liquidity ratio for Domino's Pizza. For the current ratio in 2021, current ratio of Domino's fell positive to 1.4567. Meanwhile, in 2022 and 2023, the ratio continued with ratio of 1.4734 and 1.4932. For the next one is the quick ratio. In 2021, the quick ratio was 1.341, but in 2022 and 2023, the quick ratio remains stable at 1.3214 and 1.3416, indicating the company's strong liquidity position. For the last one is the cash ratio. In 2021, Domino's cash ratio was 0.2508, although the ratio fell slightly in 2022 to 0.1125. It covered to 0.2085 in 2023, indicating that there is enough liquidity to meet short-term obligations.
I, Nur Shafiqah, will continue the presentation with profitability ratio for Pizza Hut. Firstly, profit margin shows the operational efficiency of the company in generating profits. So, for Pizza Hut, profit margin in 2021 was 23.92%, which means that for every dollar of revenue, the company earned approximately 24 cents in profits. However, in 2022, the profit margin dropped to 19.36%, indicating a decline in profitability. Remarkably, in 2023, Pizza Hut profit margin increased significantly, reaching 22.56%, indicating a significant improvement in profit margin ratio. Second ratio is return on assets ratio that assesses the company's ability to generate profits relative to its total assets. Pizza Hut ROA in 2021 was 26.4%, which means that for every dollar of assets, the company earned approximately 26 cents in profits. While the ROA fell slightly to 22.67% in 2022, it rose to an impressive 25.63% in 2023, indicating improved assets utilization and profitability of the Pizza Hut company. Third ratio is the return on equity, ROE. ROE is a metric that assesses Pizza Hut's profitability in terms of shareholders' equity, revealing the true return on shareholder investment. Pizza Hut's ROE in 2021 was 18.81%, which means that every dollar of equity, the company earned approximately 90 cents in profits. However, the ROE of the Pizza Hut company fell to negative 14.93% in 2022, indicating a loss and highlighting profitability challenges in relation to shareholder equity. And in 2023, the ROE rose to 20.32%, indicating significant challenges in profits generation. Next, for Domino's Pizza, our analysis reveals that Domino's Pizza profits margins has fluctuated over the last 3 years. In 2021, it was at 0.1172. However, it fell slightly to 0.0997 in 2022 before recovering modestly to 0.1159 in 2023. Further research into the underlying causes of these changes, such as fluctuation in raw material cost, production process adjustment, or marketing strategy revision will be useful for this and future analysis. The second profits of the Domino's Pizza ROE remain relatively stable over the 3 years, ranging from 0.2823 in 2020 to 0.3099 in 2023. This consistency suggests that Domino's company assets management strategy has remained largely unchanged. And for the last profits is the ROE. The ROE shows the most significant improvement among the three ratios. In 2021, it had a corresponding negative value of negative 2.0318, indicating that the company was losing money for its shareholder. However, the trajectory shifted dramatically in 2022, reaching a positive value of 0.106. This positive trend continued in 2023 with the ROE rising to 0.1275.
Assalamualaikum, my name is Arina. I'm going to proceed with asset management ratio by Pizza Hut. The first one is inventory turnover. In 2021, the ratio was 3.3. However, there was a drop in 2022 to 2.9 and it decreased more in 2023 to 1.4. Next one is the day sales in inventory. Pizza Hut has sold its inventory in about 109 days in 2021, which increased to 124 days in 2022 before increasing significantly to 246 days in 2023. Next is receivable turnover. In 2021, the ratio was 11.047. This trend continued in 2022 and 2023 with ratio of 10.55 and 9.6012. The next one is the day sales in receivable. Pizza Hut took approximately 33 days to collect payment from customer in 2021, slightly increased to 34 days in 2022, and increasing again to 38 days in 2023. The last one is total asset turnover. In 2021, the ratio was 1.1039, indicating that Pizza Hut sold 1.1039 for every dollar to total asset. The ratio rose to 1.1704 in 2022 and decreased to 1.1356 in 2023. The next one is asset management ratio for Domino's. The first one is inventory turnover. Inventory turnover ratio for 2021 was an impressive 39.06, while the ratio fell slightly in subsequent years to 35.41 in 2022 and 33.17 in 2023. Next is days sales in inventory. From 9 days in 2021 to 11 days in 2023, Domino Pizza maintained its rapid inventory turnover and efficient sales cycles. Next one is receivable turnover. In 2021, the receivable turnover ratio was 70.06 and it remained relatively stable at 17.62 in 2022 and 15.83 in 2023. The next one is days sales in receivable. The ratio increased slightly over time at Domino Pizza from 21 days in 2021 and 2022 to 23 days in 2023. The last one is total asset turnover. In 2021, the total asset turnover ratio was 2.6, which rose slightly to 2.8 in 2022 before falling to 2.6744 in 2023. Next, I will pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nashira Patricia and today I will proceed with the solvency ratio of Pizza Hut and Domino's Pizza. For the first part, for the solvency ratio is for Pizza Hut. Ratio, it calculates the percentage of a company asset finance with debt. Over the evaluation periods, Pizza Hut's debt ratio increased. In 2021, the debt ratio was 2.4035, indicating that approximately 240.35% of Pizza Hut assets were financed through debt. This ratio rose to 2.5183 in 2022 and then to 2.2611 in 2023. The rising debt ratio indicates a greater reliance on debt financing, raising concern about Pizza Hut's long-term financial stability and ability to service its debt obligations. Next is time interest earned. Time interest earned, also known as the interest coverage ratio, assesses a company's ability to cover interest expenses with earnings before interest and taxes, which is EBIT. Over the evaluated period, Pizza Hut's times interest earned ratio declined. In 2021, the ratio was 8.171, which means that Pizza Hut's EBIT was 8.171 times its interest expenses. However, this ratio fell to 4.15 in 2022 and then increased again to 9.2749 in 2023. The declining times interest earned ratio indicates possible deterioration in Pizza Hut's ability to cover interest expenses with operating income, which could indicate increased financial risk. And the last one is the cash coverage ratio, assesses a company's ability to cover interest expenses from operating cash flow. Pizza Hut's cash coverage ratio also decreased during the study period. In 2021, the ratio was 8.4724, which means that Pizza Hut's operating cash flow was 8.4724 times its interest expenses. However, this ratio fell to 4.427 in 2021 and then increased again to 9.5731 in 2023. The declining cash coverage ratio indicates a potential decline in Pizza Hut's ability to generate enough cash flow to cover its interest expenses, which could indicate liquidity issues and increased solvency risk for the company itself. The next part is for the solvency ratio for the Domino's Pizza. The debt ratio calculates the percentage of a company's assets financed with debt. Domino's Pizza debt ratio fluctuated during the evaluation period. In 2031, the debt ratio was 3.5179, indicating that 341.79% of Domino's Pizza assets were financed with debt. This ratio fell to 2.5183 in 2022 before rising to 3.4302 in 2023. While the debt ratio remained relatively high, the fluctuation point to changes in Domino's Pizza capital structure and financing decisions over time. Next is time interest earned. Time interest earned, also known as the interest coverage ratio, assesses a company's ability to cover interest expenses with earnings before interest and taxes, which is EBIT. Domino's Pizza times interest earned ratio fluctuated during the period. 2031, the ratio was 4.2622, which meant that Domino's Pizza EBIT was 4.2622 times its interest expenses. This ratio fell to 3.8894 in 2032 before rising again to 4.3207 in 2023. While fluctuations in the time interest earned ratio may reflect changes in Domino's Pizza profitability and interest expenses, a ratio greater than 1 indicates that Domino's Pizza interest expenses were covered by its operating income. And the last one is about the cash coverage ratio, the cash coverage ratio assesses a company's ability to cover interest expense from operating cash flow. Domino's Pizza cash coverage ratio fluctuated throughout the evaluation period. In 2031, the ratio was 4.6424, which meant that Domino's Pizza operating cash flow was 4.6424 times its interest expenses. This ratio fell to 4.2942 in 2032, but before rising to 4.7312 in 2023. While fluctuation in the cash coverage ratio may reflect changes in Domino's Pizza cash flow generation and interest expenses. A ratio greater than 1 indicates that Domino's Pizza was able to generate enough cash flow to cover its interest costs. And we'll proceed for the next part.
Hello, my name is Fatiha, and I'll be presenting about market value ratios. So market value ratios are financial metrics used by investors, analysts, and businesses to assess the valuation and market perception of a company. These ratios provide insights into how the market values a company's stock and its growth potential. So for Pizza Hut market book value, one of them is earning per share, which is EPS, measures the company's profitability on a per share basis. A higher EPS indicates better profitability. In 2021, the EPS was 5.2153, while in 2022, it went downhill to 4.5689 before rising significantly to 5.6035 in 2023. And for the PE ratios, it evaluates the company current share price relative to its per share earnings. It indicates how much investors are willing to pay per dollar of earnings. In 2021, the ratio was 24.5393, which then rose to 27.3786 in 2022 before falling sharply to 23.2016 in 2023. So other than that is a price earning to growth ratio accounts for the company PE ratio relative to its earning growth rate, offering a more comprehensive view of valuation by factoring in growth. So the PEG ratio in 2021 was 0.3178, and in 2022 this ratio shifted negative 2.209, and in 2023 the PEG ratio was 1.0395. And lastly, the NBV ratio compares the market value of a company to its book value. A negative ratio indicates that the book value is greater than the market value, which can imply potential undervaluation or issues within the company's perceived future prospects. In 2021, the ratio was a negative 4.593, and this ratio improved to negative 3.9461 in 2022 and decreases again to negative 4.6499 in 2023, indicating a potential market evaluation. And so for Domino's Pizza market book value, so for the EPS in 2021 was 5.2153, and this figure fell slightly to 4.5689 in 2022 before rising significantly to 726.82 in 2023. And for the PE ratio in 2021 was 24.5393, and this ratio rose to 27.3786 in 2022 before falling sharply to 0.75 in 2023. And for the PEG ratio in 2021 was 0.3178. However, the ratio became negative in 2022 before improving to 0.023 in 2023. And for the market book value in 2021 was negative 4.593, and this ratio improved to negative 3.9461 in 2022 and rose to 19.385 in 2023. So for overall analysis, Domino's experienced more extreme fluctuation in its financial ratios, particularly with the significant surge in EPS in 2023. This dramatic change led to notable shift in other ratios such as the PE and MBV ratios. In contrast, Pizza Hut's changes were more moderate and steady, showing a gradual recovery and a balanced approach to growth valuation. Domino's ratios reflect a volatile market response to its extraordinary earnings increase, while Pizza Hut's ratios indicate a more stable and measured recovery.
The last part is recommendation for both companies how to increase their sales and make more profit. So for the first one, as for Pizza Hut, they can do offering value menus or limited time promotions with lower price points that can attract their customers and maintain sales volume. The second one is optimizing delivery routes. As they offer delivery services, sometimes it can be expensive due to factors like delivery fees and reliance on third-party platforms. So They can optimizing delivery routes that can help them reduce delivery expenses. The last one is leverage customer data on purchase history and preferences. Pizza Hut can create targeted marketing campaigns and promotions. This allows them to reach the right audience with the right message, potentially increasing the effectiveness of their marketing spend and driving sales. And for Domino's, the first one is they can open more franchise across the country to expand their business and influence. The second one is they can offer a loyalty program that reward repeated customer and encourage them to spend more, offering points, discounts or exclusive menu items to loyal customers can incentivize them to return more frequently and potentially increase their average order value. Lastly, is they can introduce new menu items that can cater to evolving customer preferences. Adapting menus and marketing strategies to cater to local tastes and preferences is crucial for success in international market. So that is all from our group. Thank you.